What's up guys, back with another video. Let me get into bonds 3. So as I discussed last video, we're talking about bonds, their types, and their pricing. So this time we're going to talk about the bond yields. And the bond yields come with realized compound return. That's one definition that's very important. It's the compound, I repeat, it's the compound rate of return on a bond with all coupons reinvested until maturity. So instead of you taking the coupons and use them as cash out, for example, you're going to reinvest all those coupons that you make, the interest that you earn, until maturity. So realized compound return is pretty simple. All those coupons that are compounding together till maturity, you're pretty much building your money on top of money. Horizon analysis. So it's the analysis of a bond return over a multi-year horizon and is based on forecasts of a bond's yield to maturity and investment options. So basically what that's saying is that once you find out the relationship between the yield, how much time you have on that bond, etc., it tells you the analysis of, is that bond going to really be good for you? Is it going to be investment worthy? So that's the horizon analysis. There is a risk to everything, obviously, we know. Reinvestment rate risk. So as I said, you have a realized compound return because you're pretty much reinvesting all of your coupons on the bond until maturity. There is a reinvestment risk. It's uncertainty surrounding the cumulative future value of reinvested coupon payments because as we know, yield to maturity, price, we obviously know that those things do not go hand in hand with each other to make it perfect. But we do know that if you're able to study a bond and you understand that, okay, whenever there are rate fluctuations, you can know when you should invest in a short-term or long-term bond. So obviously there is some reinvestment risk because nothing is fully guaranteed. Obviously we know that we have treasury bonds, that are backed by the full faith US government, etc. But let's just say that you buy something that's a corporate bond and you decide to say, well, I don't know if it's going to be really worth it. You have to do your forecasting or you have to do a future value on that bond just to make sure that you cover all bases when it comes to risk. Because if you invest in something and you think that it's pretty good for you because everybody else says it or you read it somewhere, do your due diligence, be vigilant in understanding what you are walking into. Yes, bonds are pretty much better than common stock when it comes to being safer in the investment side, but at the same time there's always risk associated with anything we do with investing. So when you walk into a bond, just make sure you understand that once you keep reinvesting those coupon payments, that you won't be sorry about it. As I said before, another fact, zero coupon bonds, they provide all return in the form of price appreciation. So therefore, once you have it as discount, whatever you get to get back to par value, that's your appreciation. That's what you earn. You don't have a coupon on that. No coupon on zero coupon bonds. So we talked about tips. We're talking about strips now. So separate trading of registered interest and principal of security. So you're saying, what is that? So it's when there's a creation of zero coupon bonds from coupon bearing notes and bonds. So you're saying, what are you saying, Sam? So for example, you take a T-bond. Let's take a T-bond, all right? A T-bond, and you sell the coupon separately from the bond itself. So think of it as one of those flyers that you have where it says, pull here, pull this number to call here for a job or a missing dog, etc. You have to pull one of those strips. So you have the overall general bond itself, but you take the coupons individually and you sell those, and the bond itself is sold as well. And everything, every maturity is respect to each period and amount. So that means that you take a strip, you take those coupons, you get them till maturity. So what it's saying is that you have the whole bond right here and you are getting the coupons now. So zero coupon bonds that are going to appreciate, the coupons are going to appreciate till maturity. You are entitled to each one of those strips that you get, which I guess is pretty much safer than having a whole bond. But at the same time, do you want to put your investment in one thing or multiple things? So that is what you can tell yourself, ask yourself, and I do not have any financial advice for you. This is just information, so you take it how you please. But after tax returns, let's talk about tax returns on these bonds, bills, etc. for anything for bonds. So T-bills are taxed as interest, zero coupon, not capital gain. So that's one thing you need to understand. When you're investing in the T-bill, they're taxed as interest, not capital gain. So you don't got to worry about your tax bracket. You don't got to worry about the 15, 20%. They're taxed as interest rate taxes. Now, let's talk about ratings, bond ratings. So bond ratings, obviously I've discussed it many times, but people have to understand bond ratings really, really well because you might slip up and you might have a bond that's a junk bond and not an investment grade bond. So triple B's, and I always like to make this analogy, I like to make this reference. Big baller brand. If you're not a big baller brand, shout out to LeBron Ball. If you're not a big baller brand, you aren't good. So big baller brand, aka BBB and above, that means that it's investment grade. So anything above big ballers, so BBB, you're good. BBB and higher. If you're BB and lower, you're speculative. You're junk bond rated. So it's a detriment to bond safety. So what are the things that go into those bond ratings? How are they calculated? How are those ratings calculated? Debt to equity. So that's your leverage on the bond. The company's earnings to fixed costs, so their coverage ratio. Current ratio, quick ratio for the assets with no inventory divided by liabilities. Return on assets, return on your equity. Your cash flow to your debt, operating profit margin, and your debt or your EBITDA. So all that goes, and I will get into those things in another video, but all those things go into bond ratings. So basically, is a bond worth it at the end of the day for the company to be profitable, for the company to have good debt to equity, for a company to have a good current ratio, quick ratio, for a company to have good return on assets, good return on equity. So basically, is your company flowing pretty well to the point that they know you're not going to default or there's very minimal default risk? Now, bond pricing and default risk, the indenture is that it defines the contract between the issuer and the holder. So we have pretty much different types of items that goes with default risk. So we have a sinking fund, which is your indenture, so the contract between the issuer and the holder of the bond, is calling for the issuer to periodically repurchase some, not all, but some portion of outstanding bonds before maturity. So sinking fund, because it lowers the probability that a company won't pay principal payment. So if there are too many bonds out there, obviously you can have a repurchase of the bonds or a portion of them being repurchased by the company for a sinking fund provision. So that way it lowers that probability that the company won't pay that principal payment, and then obviously you won't have yourself a junk bond. Collateral, it just depends on what you want to have backing. You can have asset backed versus default, so an actual asset. You have a debenture, which is a bond not backed by a specific collateral. Excuse me, not backed by specific collateral. So basically, a debenture is just saying it's an open bond in a way that you don't have any collateral, you have anything to back it up. And then subordination clause is a restriction on additional borrowing stipulations for senior bondholders. So pretty much what that's saying is that senior bondholders are paid first in the event of bankruptcy. As we know, there are things above that, such as taxes, etc. But in the terms of when it goes between bondholders and stockholders, the bondholders are paid first because they hold debt. So that is all that I have today for the bond yields. I know there's more stuff out here like the yield curve, etc. that I have in my notes, but we're going to keep it simple. We're going to keep it on bonds. So guys, thank you for watching. Thanks for tuning in. I hope you guys found it informative. Catch me for the next video. Appreciate you guys.